Welcome back to Marginal Thoughts, everyone.
Good to be here.
You ever get that feeling, that the financial world operates on a totally different set of rules for the really wealthy? Like they're playing a different game entirely.
Oh, yeah, that's a common thought.
Yeah.
And sometimes there's truth to it.
Well, today we're going to pull back the curtain on a strategy that seems, well, kind of backwards at first glance. How rich people actually use debt to get richer.
Right. It sounds counterintuitive, doesn't it?
Totally. But stick with us because understanding this, it's not just for millionaires. It can really shift how you think about your own finances, even if you're just, starting out.
That's right. It's definitely a perspective shift. We're often taught, almost hammered into us, that debt is bad. Full stop. The enemy.
Yeah, avoid it at all costs.
And look, for certain kinds of debt, that's absolutely solid advice, especially when you're beginning your financial journey. But when you look closely at how financially successful people operate,
Hmm.
you see a much more, let's say, strategic relationship with borrowing. It's not just about avoidance.
Okay, strategic. So for most of us, when we hear debt, we think, I don't know, credit card bills piling up, maybe a car loan, stuff that feels like a weight.
Exactly. High interest stuff, often for things that, well, they don't make you money. They depreciate.
Right. So let's draw a line here. This idea of good debt versus bad debt. Can you break that down simply?
Sure. So bad debt, generally speaking, is borrowing money for things that lose value over time or don't generate any income. Think financing a fancy TV that's worth less the minute you take it home.
Okay, makes sense. Or using a credit card for a holiday you can't really afford yet.
Precisely. Now, good debt, that's different. It's typically debt you take on to buy something, an asset that has the potential to go up in value or to generate income for you. Ideally, income that's more than what the debt is costing you in interest.
Ah, okay. So the focus today is really on that good debt side of things, how the wealthy leverage that.
Exactly. It's about understanding how they use it, not just as something to be managed, but as an active tool for building wealth.
Okay, let's dig into that. Using debt as a tool. What's the basic idea behind it?
The fundamental principle is, well, it's leverage. Using other people's money, basically.
Other people's money, like the bank's money.
Yeah, typically a bank or lender.
Hmm.
Think about trying to lift a really, really heavy rock. You could just try and grunt and lift it yourself.
Right. Probably fail. Or hurt myself.
Right. Or you could find a long, strong stick, prop it under the rock,
Yeah.
use it as a lever. Suddenly you can move something much heavier with way less effort.
Okay, I get the analogy.
Financial leverage is kind of the same idea. By borrowing money, you can control assets like property or investments that are worth much, much more than the actual cash you put down.
So you're amplifying your own money's power, in a way.
That's a great way to put it. But, and this is crucial, the goal isn't just to control bigger assets. The goal is for those assets to work for you, to generate more income than the cost of borrowing that money in the first place.
So it's definitely not about reckless borrowing, like just getting loans for anything.
Yeah. Absolutely not. It's very strategic. It's about acquiring things that pay for themselves and then some. It requires calculation, understanding the risks, and having a plan.
Okay, let's make this more concrete. What are some common ways this actually plays out? Real estate often comes up, right? Buying rentals.
Yeah, real estate is a classic example. A mortgage, in many cases, can be a form of good debt.
How so?
Well, think about buying a house or an apartment. You usually put down a percentage of the price, maybe 10%, 20%.
Down payment, right.
Exactly. And you borrow the rest from a bank that's your mortgage. Now, if you buy that property not to live in, but to rent out.
Ah, okay. To tenants.
Right. The rent that your tenant pays you each month can, ideally, cover your entire mortgage payment, the principal and the interest, and maybe even leave a little extra cash flow for you.
Okay, let's try some easy numbers. Say a house costs $200,000.
Okay.
And maybe you get a $200,000 mortgage, just for simplicity. Let's say interest is 5%. Your payment might be around, what, $1,350 a month? Rough numbers.
Sounds about right for that scenario, yeah.
But if you can rent that same house out for, say, $1,500 a month.
Then bingo. Your tenant is essentially paying off your loan for you. Plus, you're getting $150 positive cash flow each month before other expenses like repairs or taxes, of course.
So you control a $200,000 asset, maybe with very little of your own money initially tied up, depending on the down payment, and someone else is paying the debt down.
Precisely. And there's another layer, too. What often happens with real estate over the long term.
It tends to go up in value, appreciation.
Exactly. While your tenant is chipping away at that mortgage balance, the underlying value of the house itself could be increasing. So you're potentially building wealth in two ways: the
Yeah.
debt reduction and the appreciation,
Hmm.
all powered initially by borrowed money.
Okay, that makes a lot of sense for something physical like property.
No.
What about the stock market or other kinds of investments? Can you borrow to invest?
You absolutely can. The principle is very similar, actually. You
Yeah.
borrow money at one interest rate,
Yep.
and you invest that same money into something else, stocks, bonds, a business venture that you expect will give you a higher rate of return.
So you're betting you can earn more on the investment than you're paying in interest on the loan.
That's the core idea, yes.
Yeah.
You're aiming to profit from the spread, the difference between your investment return and your borrowing cost.
Can you give us a simple example of that?
Sure. Let's imagine someone borrows $100,000. Maybe it's a line of credit, maybe a specific investment loan. Let's say the interest rate is 7% per year.
Okay, so that costs them $7,000 a year in interest.
Right. Now they take that $100,000 and invest it. Let's say they put it into a portfolio of stocks or funds, and over the year, it generates a 15% return.
So the investment made $15,000.
Exactly. So they earned $15,000 from the investment, but they had to pay $7,000 in interest on the loan.
Which leaves them with an $8,000 profit.
Precisely. $8,000 they wouldn't have made without using the borrowed money.
Right.
Now, obviously, you have to factor in things like taxes on the gains, maybe some fees.
And the big one, risk, right? The investment could go down.
Huge risk. Absolutely. If that 15% return was actually a 5% loss, you'd still owe the $7,000 interest, plus you'd have lost $5,000 on the investment. So this strategy, often called investing on margin when done with stocks, is definitely not for the faint of heart or the unprepared. It magnifies gains, but it also magnifies losses.
Got it. So higher potential reward, but definitely higher risk. Okay, what about businesses? Even like regular non-financial businesses. Do they use debt strategically?
Oh, all the time. It's fundamental to how many businesses operate, even really simple ones. Think about someone who sells pens, just simple pens.
Okay, a pen seller.
They need to buy a bunch of pens from a manufacturer or wholesaler first, right, to have
Yeah.
stock to sell.
Sure, need inventory.
But maybe they don't have the cash up front to buy, say, 10,000 pens. What they might be able to do is get those pens from the supplier on credit.
Meaning the supplier gives them the pens but lets them pay later.
Exactly. Maybe the supplier says, okay, take the pens. You have 30 days or 60 days to pay me back. This is called trade credit.
Oh.
So the pen seller takes the inventory, sells the pens to customers, collects the cash,
Right.
and then uses that cash to pay the supplier back before the deadline if they sold the pens for more than they owe the supplier.
They keep the difference as profit without having to put up their own money for the pens initially.
Exactly. They've used the supplier's willingness to extend credit, a form of short-term debt, to finance their operations and generate profit. Now, this relies heavily on trust and relationships, of course. The supplier needs to trust they'll get paid.
Okay, that's clever. It's like a mini loan built into the supply chain.
Now, another one involving real estate, but slightly different, refinancing. How can that be used to, well, get ahead?
Right, so this often happens after someone has owned a property for a while, especially if they've improved it.
Like doing renovations.
Exactly. Let's walk through an example. Say someone bought a property for $500,000. They put down 20%, which is $100,000, so they have a mortgage for $400,000.
Okay, standard purchase. Now, they spend, say, $50,000 of their own money doing up the kitchen, bathrooms, making it look great, and because those renovations, the market value of the property jumps up. Maybe it gets appraised at $700,000 now.
Wow. Okay, so the 50K investment really paid off in increased value.
It seems so in this case, yeah. So what they can do now is go back to the bank and say, hey, my property is worth a lot more. I want to refinance my mortgage.
Meaning get a new loan.
Yes, a new loan based on the new higher value. Let's say the bank is willing to lend up to 80% of the new value. 80% of $700,000 is $560,000.
So they can get a new mortgage for $560,000.
Potentially, yes.
Yes.
Now, what do they do with that $560,000? First, they have to pay off the original $400,000 mortgage.
Okay, that leaves $160,000.
Right. Then they might use, say, $50,000 of that to pay themselves back for the renovation costs they initially spent.
Recouping their investment. And that still leaves
$110,000. Cash in hand. Tax-free, typically, because it's loan proceeds, not income.
Whoa, so they own a more valuable property, they got their renovation money back, and they pulled out $110,000 in cash, all initiated by borrowing.
Essentially, yes. They now have a larger mortgage, $560K versus $400K, but they unlocked a chunk of the equity they created through the renovation, turning it into usable cash, perhaps for other investments, while still owning the appreciating asset. It's a way to access the value you've built without selling.
That's pretty powerful. Okay, this next one sounds almost like myth. The idea that the super rich get access to basically free money through loans. How on earth does that work?
Yeah, free money is maybe a bit provocative, but the concept is rooted in the incredibly low interest rates that very wealthy individuals or large corporations can sometimes access. We're talking rates that can be lower than the rate of inflation.
Lower than inflation. So hang on, inflation means money loses value over time, right? Like a dollar today buys more than a dollar next year.
Exactly. Inflation erodes purchasing power. So if you can borrow money at, say, 1% interest per year,
Okay.
but inflation's running at, say, 3% per year.
Yeah. Then the value the money loses due to inflation is actually more than the interest you're paying.
You got it. In real terms, after accounting for inflation, the cost of borrowing is effectively negative. You're paying back the loan with dollars that are worth less than the dollars you originally borrowed.
That seems unfair. How do they get rates like that? I mean, there were reports about Mark Zuckerberg getting a mortgage around 1%, right, on a multi-million-dollar home.
Yeah, examples like that pop up. It boils down to a few things. First, risk. From a bank's point of view, lending millions to someone with billions in assets is incredibly low risk. They have massive collateral and capacity to repay.
Okay, they're a safe bet for the bank.
A very safe bet. Second, it's about relationships and future business. Banks want to attract and keep ultra-high net worth clients. Offering them exceptionally good rates on a mortgage might be a way to secure their broader banking business, their investment management, their company's financing needs, which could be worth far more to the bank in the long run.
So the cheap mortgage is like a loss leader, almost, to get the bigger relationship.
It can function that way sometimes, yeah. And think about the opportunity cost for the wealthy person. If they can borrow at 1%, why would they tie up, say, $10 million of their own cash buying a house outright,
Right. They could borrow the $10 million at 1%.
costing them $100,000 a year in interest?
And potentially invest their own $10 million in their business or the market, maybe aiming for a 7%, 8%, 10% return.
Exactly. They could potentially earn $700,000 or more on their capital, easily covering the $100,000 interest cost and profiting significantly. Even putting it in relatively safe bonds yielding, say 3%, would net them a profit over the 1% borrowing cost. That's why borrowing, even for huge purchases, makes mathematical sense when rates are that low relative to potential investment returns.
Okay, mine's slightly blown, but this has been super insightful. We need to bring this back down to earth for our listeners, especially those who are maybe just starting to figure out their finances. What are the key takeaways for beginners?
Absolutely. The number one thing, I think, is to really hammer home that distinction between good debt and bad debt again. What we've been talking about leveraging debt for assets is an advanced strategy.
Not step eight.
Definitely not step one. For beginners, the absolute priority should be avoiding or getting out of high-interest, bad debt, especially things like credit card debt carrying 20% interest or more. That kind of debt works against you, draining your wealth.
So don't hear this and think, great, I'll max out my credit cards to buy stocks.
Please no, that would be disastrous. The risks we touched upon, asset values falling, investments underperforming, are magnified hugely when using high-cost debt or when you don't have a solid financial cushion or deep understanding.
Right. And it's critical to understand the terms of any loan, right? Like, is the interest rate fixed or variable? What are the fees?
Absolutely essential. Read the fine print. Understand exactly what you're signing up for. Also, remember diversification, not putting all your borrowed eggs in one basket, although that's a whole other topic. The strategies the wealthy use often involve sophisticated planning, diversification, and professional advice.
So for someone starting out, the focus should be
Build a solid foundation first. Save money, create a budget, pay down or avoid high-interest debt. Learn the basics of investing with your own money. Understanding how the wealthy use debt is valuable perspective, it shows you what's possible later on, but it's not the starting playbook.
That's a really important clarification. Okay, so wrapping up, it's clear that the relationship the wealthy have with debt is, well, way more complex and strategic than just debt is bad.
Definitely. It's about seeing debt not just as a liability, but as a potential tool, a lever, to acquire assets and potentially accelerate wealth creation, if used carefully and correctly.
So what are your initial thoughts hearing all this? Has it challenged how you maybe thought about debt before? It certainly made me think.
It often does.
We genuinely love to hear your questions, your insights, maybe your own experiences down in the comments below. Let us know what clicked or what still seems confusing.
Yeah, definitely join the conversation.
And if you found this deep dive into the slightly different financial world of the wealthy eye-opening, make sure you hit that subscribe button for marginal thoughts. We explore this kind of stuff all the time, trying to figure out how things really work.
Thanks for tuning in, everyone.
See you next time.